One minute they were legends, masters of the universe worth billions. The next, it was all gone. And the terrifying part? You and I are making the exact same mistakes right now. Most people study the wins of famous traders. Their bold calls, their riches, their genius. But the truth is, the biggest lessons come from their failures. That's where the gold really is. So today, we're dissecting 3 of the most famous trading blowups in history. I'll show you the one critical mistake that doomed each trader, and I'll give you the simple rule you can use to make sure it never happens to you. Let's get into it. In March 2021, Bill Hwang's family office, Archegos Capital, vaporized $20 billion in just a matter of days. And here's the thing, Hwang wasn't just some reckless day trader. He was a legendary investor who once ran billions for Julian Robertson at Tiger Management. So what happened? The fatal mistake was uncontrolled, concentrated leverage. Hwang used something called total return swaps. Instead of buying stocks outright, he made deals with banks to gain exposure to stocks without showing up as the owner. This let him secretly build enormous positions in a few companies like Viacom CBS and Discovery. On paper, he controlled over $100 billion worth of stock, with only a few billion in actual capital. That's 20x leverage. When Viacom CBS started to fall, the banks demanded more collateral. Hwang couldn't deliver. Margin calls hit. The banks panicked, dumped his stocks, and that selling pressure caused a death spiral that wiped Archegos off the map. So, what's the lesson for us? I call it the 5% rule. No single position should ever be so large that a 50% drop would wipe out more than 5% of your total portfolio. If you've got a $10,000 account, the maximum loss on any trade should be about $500. That means sizing your positions carefully and never maxing out your margin accounts. Because once leverage turns against you, it's game over. Now let's rewind to 1995. A 28-year-old trader in Singapore named Nick Leeson brought down Barings Bank, a 233-year-old institution that once financed the British Empire. He lost $1.3 billion. How? Leeson wasn't just a trader. He was also in charge of setting his own trades. That's like being both the player and the referee in a soccer match. Nobody was checking his work. He used this freedom to hide his losing bets in a special account numbered 88888. Every time he lost money, he doubled down, thinking he could trade his way back to even. Instead, he dug a deeper and deeper hole until the bank collapsed. So what's the takeaway? You need to be your own compliance officer. That means journaling every trade before you make it. Write down your reason for entering, your price target, your stop loss. And here's the hard part. When the stop loss hits, you exit. No second chances, no doubling down. Your journal is your boss. Because if you let emotions call the shots, you're walking the same path as Leeson. Our final story is one of the biggest blowups in financial history. Long-term capital management in 1998. This wasn't just some cowboy hedge fund. LTCM was run by Nobel Prize winners and PhDs. They had the smartest models in the world, and those models told them their trades were basically risk-free. Their strategy was called convergence trading. They bet that small differences in bond prices would eventually align. The profits were tiny, so they used massive leverage to juice their returns. And it worked. Until it didn't. In 1998, Russia defaulted on its debt, a true black swan event. Suddenly, LTCM's uncorrelated bets all went the wrong way at the same time. Their billions evaporated almost overnight, and the Federal Reserve had to step in with a bailout to prevent a global financial meltdown. So, what's the lesson? Even if your model says you can't lose, expect the unexpected. The elite rule here is simple. The markets can stay irrational longer than you can stay solvent. Your takeaway? Diversify not just your stocks, but your strategies. If every trade in your portfolio depends on the same condition, like low volatility, then you're just one black swan away from disaster. Always ask yourself, what if I'm wrong? And have a plan for that. So let's recap the 3 sins that destroyed these legends. Bill Hwang's sin, too much leverage on a concentrated bet. Nick Leeson's sin, no oversight and no discipline. LTCM sin, ignoring tail risks and over-trusting models. Now, here's your blow-up proof checklist. Leverage. Do I truly understand the size of my risk? Plan. Do I have a written entry, target, and stop? Black swan. Am I overly exposed to one outcome, or am I diversified? Follow this checklist, and you'll avoid the same fate as some of the smartest traders in history. The difference between a good trader and a blown-up trader isn't intelligence, it's risk management. These legends were geniuses, but they broke the rules and the market punished them. So I'll leave you with this. Which mistake are you most guilty of? Over-leveraging, skipping stop losses, or betting too heavily on one theme? Be honest in the comments. And if you want more breakdowns like this, hit like, subscribe, and stick around for the next Elite Trade Club video. This is not financial advice, it's for educational purposes only. Trading is risky, and you can lose more than your initial investment.